speaking with us here at CNBC TV18. The Nifty is down, what, 52 points. We are at 17,255. So, I mean, it's been like that since the start, which is about 45 minutes into trade today. Gautam Duggad is head of research institutional equities at Motilal Oswal Financial Services. I mean, he's the numbers guy. How are earnings really tracking for the market, and what will they look like going forward? I mean, stock prices at the end of the day, after everything is said and done, are slaves to earnings and earnings growth. Gautam, it's a pleasure. Great to have you here. Thanks very much. Prashant this side. Could you first of all tell us how have earnings estimates for the full year moved, post the third quarter earnings? And also, I mean, how have you seen any changes to FY23 earnings? I know it's still some time away, but one starts to tend to see changes there as well. And which parts of the market on the Nifty, which sectors are we seeing bulk of these changes, if any? Go on.
Good morning, Prashant. Thanks for having me. So this is a very interesting earnings season, Prashant. If you look at the aggregates, you will find that things are hunky-dory. We had expectations of 25% earnings growth for Nifty. 25% is what we got. And for our broader coverage universe, again, it was in line at about 22%. But aggregates hide a lot of things as always. You've seen a very broad-based and a severe margin contraction across the board. So much so that you got a top line growth of 30%, but the EBITDA growth is just 15%. So the gap between EBITDA and profit growth is largely because of the lower provisioning in financials and also the deleveraging that we have seen in metals. Be that as it may, the aggregate numbers were in line for both Nifty as well as our broader coverage of 220 stocks, right? Secondly, the quarter was very skewed in a sense that three sectors have driven the entire 100% of the incremental growth. The metals, oil and gas, and financials. If you take out these sectors, there was no growth. It was minus 1%, which still was in line, but that tells you how narrow the quarter was in terms of earnings performance, right? And on the disappointing side, you had sectors like auto, consumer durables, cement, pharma, which posted a YOY earnings decline. And big sectors like consumer and IT were in line, but with a very modest growth at about 6 to 10%. Now, to answer your second question on how the estimates have changed, again, the estimates are stable for both FY22 and 23 as far as Nifty is concerned. So we've seen a marginal 1% cut in FY22 Nifty EPS from 743 to about 735, and that also is largely because of Tata Motors. For FY23 and 24, we are stable at about 875 and 1,000 rupees. So you can say marginal 2 rupees uptick in both FY23 and 24. So what has happened is the downgrades which came because of auto, consumer durables, cement, and to an extent consumer staples got overcompensated by the upgrades that we have seen in commodities and to an extent also in financials. But this is for Nifty. If you look beyond the Nifty, the earnings breadth was very poor this time. You've seen 40% of the companies missing our estimates and just about 32% beating our expectations. If I were to translate that into the forward revisions, you've seen downgrade to upgrade ratio at about 1.5 times.
Sure.
Right?
Actually,
this has not happened for the last 2 quarters.
I want to come back to that point you were making about the strength that we've seen in financials, because I went through your report in which you say that you're overweight on many of these large banks, and most of them delivered very strong numbers this time, right? Whether it's ICICI Bank, Axis Bank, SBI. Do you think the trend is something that can continue? And what has been the standout performance for you earnings-wise within financials?
Financials has been the single largest outperformer as far as earnings are concerned this quarter. They delivered about 35% growth versus expectation of about 25%. And it was quite broad-based. Both PSU banks, private banks, NBFCs have outperformed on expectations. So this was the only sector which actually stood out in terms of both absolute and relative performance. And this has been the case now for the last 5-6 quarters. Throughout the pandemic, we have seen that large banks have shown very strong, resilient earnings performance. If you look at the bank's earnings, Nifty Bank's earnings or Nifty Financial's earnings, it bottomed out in FY18 at about 45,000 or 48,000 crores. And we did about 1,11,000 crores last year in FY21. This year, we are on our way to do about 1.5 trillion. And next year's expectation is about 1.9 trillion. The only caveat that I have is our preference is still more towards the large cap financials, because the mid and small caps are still not in the pink of their health as far as financials are concerned. The asset quality, the restructured book, large caps are far better placed, and we are now seeing some evidence of even the loan growth coming back. So they are very well positioned, and even from a valuations perspective, this is the only mainstream sector today where the valuations, I think, are very reasonable now after 2 years of underperformance.
Okay. Hi, Gautam. As you were taking us through all those cues, I was recalling a time in the last few years I've reached out to you numerous times, and that Nifty EPS was stuck in that 500, 550 to 600 range. Now, for this year, you're pegging it at around 735, which is pretty good. And then you're working with, a big growth of close to 18-19% for the coming year. Now, this is 140 rupees that we're going to see in terms of an EPS growth. Which are going to be the key constituents to it, the contributors?
Yeah, just to correct you, we were stuck in 450 to 500 range for 5 to 6 years.
Yes.
And 21 was the first year where we have seen a 15% growth.
So we're talking longer than that then, Gautam. I remember, 450, 500, 450, 500, that was forever. But you're making that point. Go ahead.
And now we are on way to about 36% growth in FY22. To answer your specific question on FY23, there are 4 sectors that are going to drive 100% of the incremental earnings. Financials, obviously, because they're a large part of the index. Then oil and gas, IT, and auto. This 4 sector comprise 100% of the incremental earnings. There's one big change between FY22 and 23. In 22, you've seen single largest contribution to growth coming from a sector like metals, which enjoys just about 3% weight in the index, but contributed 35% of the incremental growth. Metals is not going to be a contributor in FY23.
No, so I just wanted a quick word on metals, where profit growth, etc., has been extremely strong. Companies are deleveraging, but stocks are still available at 4 times, 5 times earnings. So what is the market telling us? I mean, is it because the facts are well known? They've been well known for a while that there is a huge upcycle and things have never been this good, perhaps. Is the market pricing telling us that the markets don't believe that this is here to stay? I mean, these kind of numbers are here to sustain. Is that the takeaway?
Prashant, you have to look at metals in the context of what is happening globally, right? Because it's always a global play and what happens in China and LME. So if you look at the last 4 or 5 months, the pricing element of the commodity, especially the ferrous side, has lost the momentum, So from September or October onwards, you have not seen any momentum in the underlying commodity pricing and steel prices. So that is where the stocks have also stopped, rallying. They have not corrected a whole lot, by the way. The good thing is that the pricing is coming back, but you also have the pressure of input cost. And we've seen throughout the earnings season, every company in every sector talking about input cost inflation across the board. So I think till the time you don't see a visibility on pricing moving up and some stability emerging on the input cost side, prices will remain range bound. As far as multiples are concerned, yes, the multiples are cheap and lucrative, but they've always been like that. The sector has never traded beyond 7-8 times on EV/EBITDA in the up cycle and has not gone below 3-4 times usually in a down cycle. The good thing, however, is there is a deleveraging which is continuing. Some of the companies are now coming out and saying that we are now going to invest in capex, organic growth. So deleveraging might slow down a little bit from here on. But yeah, last 2 years, we've seen a massive deleveraging in almost all the big metal stocks.
Sure. One final question, Gautam, from my end. There's a raging debate ongoing about these platform companies, right? There's loss after loss that they're posting, whether it's a Paytm, PV Fintech, Zomato, even Nykaa's profits fell quite a bit. But we do know that some of these businesses are the businesses that will sustain in the future. I mean, anyone and everyone is now ordering on Swiggy and Zomato's and their volumes have gone up. But tell us, how do you sift the wheat from the chaff here? What would your buys be despite the weakness that we've seen in the numbers?
So, Sonia, right now, we don't have a coverage on any of these names. The view is very simple. These are great, some of them are great franchises. They've built businesses over a period of time. Their top line, as we all know, has grown in the last 4 or 5 years. They have a long runway ahead for growth. The problem, however, is cash flows and earnings. And a market is getting slightly more concerned given the rate environment that we find ourselves in. And all of us know the classic cash flow valuation techniques. Whenever your rates go up, the long duration distant future cash gets compressed the most in a rising rate environment. So today you don't have a handle whether something is, which was available at 100 rupees, and today if it is available at 50, 60 rupees, if it is cheap or not, because the denominator is upset. Basically, the denominator of earnings or cash flow is upset. So one has to be extremely adventurous to take a call on whether the bottom has been made or not. I would be in the camp which will wait for earnings and cash flows to emerge and stay sideways on some of these names, because there's no compulsion to own these names. You can appreciate their business models while staying sideways as well.
I take that point completely. You can be their customer very happily and loyally, right? But you don't have to buy into the losses that they are generating for themselves. There are many
Absolutely.
other fish out there in the ocean. Got that. Okay, Gautam, always a pleasure speaking with you. Thank you so much for joining us. We've run out of time, but we'll speak again later. So that's a complete deep down analysis on the earnings, the takeaways from the earnings season. But we have to slip into a short break. It's very, very quiet today, which is a good thing. I guess the market needs some time off from all the volatility. When we come back from the break, Mitesh Thakkar will be joining in. He'll give us some technical trades. Stay tuned.